Hello, my name is Rick Gray. I'm a certified public accountant and founder and president of Global Tax Service. Global Tax Service specializes in preparation of individual taxes for U.S. taxpayers, whether U.S. citizens or U.S. resident immigrant aliens, living and working overseas. We have clients who are working for international conglomerates overseas, who work for international nonprofit organizations overseas, who are entrepreneurs. But the niche that we most focus on is educators working in American, international, local schools or campuses of U.S. colleges and universities outside the United States. We've been in this business now for over 20 years, and we believe that we can provide valuable advice to you, whether or not you use our services for tax preparation. Before I begin, I want to make a small disclaimer, and that is, while the information we're providing is accurate, it may not describe your specific situation. So if you have individual questions, please contact us. Once you go overseas, you may think you're done filing state tax returns, but think again. Most states require that you continue filing state tax returns in the state in which you were last resident before moving overseas. While it's true that 7 states have no income tax, 2 states tax only unearned income, meaning interest and dividends, the remaining states normally expect you to file a tax return each year that you file a federal tax return. This is because they have something called domicile, and you continue to be domiciled in the state in which you were last resident when you move overseas, even though you're no longer physically resident in that state. Some states make it easy. In Georgia, for example, if you don't live in the state for 183 days during the year, you're not required to file a resident return. If you have Georgia source income, you can file a non-resident return to report that income to the state of Georgia. In Illinois, you have no further filing requirement after you've lived overseas an entire calendar year. But for the other states, they expect you to file a state tax return if you file a federal tax return. And in Maine, they recognize the foreign earned income exclusion. But there are exceptions to that rule as well. There are several states that require you to file a state tax return and that don't recognize the foreign earned income exclusion. The worst example of that is Alabama. Alabama requires that you pay state income tax on your foreign earned income until you actually establish domicile and residence in another U.S. state. Neither do they have any way for you to escape paying that tax through a safe harbor program, which some states do have. California, for example, does tax foreign earned income, but you can qualify to file as a non-resident and not pay tax on your foreign earned income if you meet their safe harbor test. Generally speaking, meeting the safe harbor test means you're limited to spending not more than 45 days in California in any tax year. So long as you're outside California for all except up to 45 days, you can file a non-resident California return and pay tax only on any California source income. Even if you have no California source income, we recommend that you file the state non-resident return if you otherwise qualify, because California is very avaricious about collecting taxes. The Franchise Tax Board will send you a notice that you owe them tax on your federal income if you fail to file a return and you use a California address as your U.S. address in filing that return. It's important that you understand what makes up domicile. There are several considerations that each state gives, and they give more weight to some items than to others. Examples of things that they'll look at is, where do you have your professional license? If you're an educator overseas and your license is from the state of Illinois, that's an indices that Illinois is your domicile. They will look at where your family ties are, where you have your bank accounts, where your financial advisor may be located, where you went to school, where you maintain a home if you still maintain a residence in the United States, or if you have rental property that was formerly your residence. They also look at where you have your driver's license from, where you registered to vote, and in some states, where you have bought hunting or fishing licenses in the past few years. If you want to change your domicile because you're in a state that's unfriendly to U.S. taxpayers living overseas, you need to check as many of the boxes as you can in another state. The ideal solution is to buy real estate in a state that's tax-friendly to people overseas, to change your driver's license, your voter registration, and your bank accounts to that state, file one final part-year return in the state where you were formerly domiciled, and generally you can then proceed filing whatever tax returns are required in your new state. Obviously, if you elect to do this, we would recommend that you elect a state that doesn't have a state tax so that there's no problem even if you return to the United States. One of the things that most often causes people to end up owing late taxes is because they return to the United States and to the state where they were formerly domiciled. If your intent is to return to the state that you left, the state legitimately can collect back taxes for you from 3 to 7 years when you move back to the United States. So be aware of the fact that you have a domicile that is probably in a state in the United States, and be sure that you comply with their requirements for tax filing, and if necessary, do what you need to do over several years' time in order to escape paying local tax in those states that don't recognize the foreign earned income exclusion. If you have questions on any of this or questions about a particular state, please drop us a note at info@globaltaxonline.net. That's info@ and then all one word, globaltaxonline.net. Provide your name and the country in which you reside. Thank you for your time.